If you've never watched any of our video contents, or you've never watched any of our video contents from beginning to end, this one right here, this video, is one that I would say you have to watch this from the beginning to the very end, because every single information I'm about to give out right now in this video is going to help you, whether you're a beginner trader or you've been trading for years. This video right here is packed with 7 years of me being in this industry, every single thing that I use in my trading, from how to derive a bias to how to know areas that I'm going to use as my point of interest, understand the areas of discounts, to entries, to re-entries, using the smaller time frame from 5 minutes to 3 minutes time frame. Every single thing I'm going to share in this video, so watch it from beginning to the very end. Now we're looking at euro US dollar, and as you can see, we're currently on the 6-month time frame. If you want to understand where the market is going to, the best time frame is usually the 12 months or the 6 months. These two time frames, they will simplify directional bias. I don't care whether you've been trading for 6, 10 years, or for 1 year, or for 1 month. The moment you understand this time frame right here, it will simplify how to derive overall bias. This makes it so easy for you to come into the chart and know, am I going to be a buyer or am I going to be a seller? Absolutely easy. The moment you come into this chart, the first thing, you mark out your higher highs and your higher lows. This will already give you a clear understanding what's the overall market direction. What is the overall market direction? Are we bullish? Are we bearish? This right here simplifies it all. And as you can see very, very clearly, we are massively bullish. Every single time we've seen price come to the downside, it's eventually rallied higher to create a higher high. And every time again it came to the downside, it's rallied higher to create a higher high. This already indicates that this market is bullish, despite the fact that from 2008 we've been in a downtrend. It doesn't take away the fact that we are bullish. You can see how many years it's taken us to go on the downtrend. It's taken us from 2008 to 2024. How many years is that? That is a very long time ago. That is 5,844 days we've been bearish. And look, whenever we went to the upside, it took us a very shorter time, 2,920 days. The impulse leg takes shorter time. The retracement takes longer time. Right here, impulse leg to the high, 3,653 days. You can see it there. Now, coming down, in this case, coming down, it took us 2,009 days. It took us a longer time to go up here. It took us a shorter time to come down. If we now start to use our Fibonacci, you will see I'm going to teach you how to use the Fibonacci from the bigger time frame to the smaller time frame. Right now we're on the 6-month time frame. If we use the Fibonacci from this low created right here to this high right here, this high, this low, this is extreme discount. Look what happened right there. Price failed to close below it, showing us there was an accumulation. Look what's resting right there. Inefficiency. Price came down, mitigated the inefficiency, resting at an extreme discount, and after that, expansion. Now we're going to use the Fibonacci again. From this low to this high. This right here is equilibrium. Anything below it is discount. Price came into that discount zone, didn't tap the extreme discount. What did we mitigate right here? Inefficiency. We mitigated that inefficiency. After that, we had expansion. We'll go again from this overall low to this overall high. And what do you see right here? Price came into an extreme discount. What is resting at an extreme discount? Inefficiency. Can you see how the inefficiency aligns with the discount zone, the extreme discount zone? This is how you derive your point of interest. How you align the discount with the inefficiency to derive a point of interest. This is a point of interest. Now, an inefficiency could be resting at any place, any key level. What makes it a point of interest is whether that area is an area of discount or an area for premium. Another example, look at this inefficiency resting right here, resting at a premium zone. Anything above the equilibrium is premium. Look at how we came into that premium zone, inefficiency at the premium. What happened? We dropped. We came back again for another mitigation. What happened? We dropped again and dropped straight into another inefficiency, which is another point of interest. So this right here was a point of interest for sells. This right here was a point of interest for buys. Now, the reason why I'm showing you this Fibonacci inefficiency, the reason why I'm showing you this Fibonacci right here from the low to the high is for you to understand that we are at a discount zone. Despite the fact that we're seeing all these fluctuations in the market for euro US dollar going up and down and up and down, we are still at a discount zone. Price is still at a discount zone. So trades that will provide higher probability are buys. It doesn't mean you can't catch a sell. This right here was a sell. You could have gotten into a trade, you would have made money on this sell. It was a big sell-off. But look at someone who kept buying. That person would have had 6 months of profitability, another 6 months of profitability, another 6 months of profitability. And then this one right here. That's still another ongoing 6 months. The person would have been in profitable trades. So someone selling it, unless you're selling for 1:2, 1:3, but you can't actually hold on to any sell for longer because market will eventually reverse to wipe you out. But someone who was buying it could actually hold those trades to deliver 1:5, 1:6, 1:7, 1:8, 1:10 by looking for discount zones, extreme discount zone on the intraday levels, which I'm going to show you in this video. Now that we've derived that our overall market direction is bullish, which is for the market to go to the upside, the next thing we will look for is where is our low resistance liquidity? Where is the low resistance liquidity that overall, while we're looking for a buy from this discount zone, we'll be targeting a low resistance liquidity that is either at equilibrium or directly above equilibrium. And where is the low resistance liquidity? It is resting right here. right there is our low resistance liquidity. Now, I know some people that are very new to our channel, new to our page. You're watching this video for the first time and you're wondering, what is low resistance liquidity? I'll explain that in a nutshell. A low resistance liquidity is an area of accumulated liquidity. Price has intentionally induced a lot of liquidity. This is what a low resistance liquidity looks like. This, we have a high, price came to the downside, came up, failed to create a higher high, failed to take liquidity from the previous high, and drops, creating a lower low. This right here is induced liquidity. Price is piling up more liquidities because a lot of traders are going to be setting their stop losses right here, right here. That is what you're seeing here. Stop losses are here, more stop losses are here, and this is both retail and institutional stop losses are resting at this significant highs. That is why this is a low resistance liquidity, because there was no external run on liquidity before dropping below these lows. One thing I'm going to tell you in this video today is why it is very essential to understand the 6 months time frame, to understand the directional bias from the 6 month time frame. Why this is very essential, very important, is because it's going to help you know when you're being manipulated on the intraday time frame. Now, if we go to the weekly time frame, you could potentially see that whatever price did here, there was a break of structure to the downside. Now, what that means is retail traders will be looking for opportunity to sell euro, which is understandable. But why it's essential to understand the 6 month time frame is it gives you a better perspective to not look for those sells for long term. You can look for a short term sell, look for a low hanging fruit area and exit. But if you're looking for a long term sell on euro, to sell it to take any significant lows, there's a very low chance for that to work in your favor. It could work a few times, but you will take more losses along the way. Now, everything I'm saying in this video is pretty much my opinion from my own personal experiences from the people that I've mentored. And I have seen countless profitable trades on the buy side. So now what we're going to do now is we're going to start to scale down time frames. And the first one we go is to the monthly time frame. Now we've derived our overall market direction, overall key levels to anticipate for the market to gravitate to, which is our low resistance liquidity. The next thing we now do is we start to look for intraday setups, and I'm going to share with you lots of examples of how you could have been anticipating for buys consistently. The first thing to do right now on this time frame, you can see we're still at discount, overall discount. We're still at a discount zone. Now, on the monthly time frame perspective, as you can see, we have our lower high, we have our lower low. And on the monthly time frame, it kind of seems like price is bearish because this is a lower high and a lower low. And this right here is a break of structure. So as you can see very clear, right here, lower high, lower low. So this is pretty much a break of structure on the monthly time frame. So it's very safe to say monthly is bearish. So let's look for a sell. Very safe to say that. Any trader that says that, I'm not going to say, oh, you're a bad trader, you don't know what you're doing. Absolutely not. Because you're absolutely right. That is exactly what it looks like. Absolutely right. That is absolutely exactly what it looks like. A lower high and a lower low. You are very right to look at this and say, we're bearish, I want to keep looking for a sell. And boom, you're looking at this inefficiency. You'll keep targeting this inefficiency. You can target this inefficiency and the price may decide never to come down in here. And each time you sell it, targeting here, look what happened. You sold it here, came very close, didn't mitigate it, rallied again. And you sold it again, came very close, rallied again. Now you're wondering what is going on. This is what's going on. We're bullish. Stop letting these other time frames confuse you, because they are meant to confuse you. They are not meant to make you profitable. They are meant to keep you in the loop, keep you running around. They keep you from becoming a profitable trader, keep you from taking good trades. And let's get down to weekly. Then weekly even pretty much damages the trader's mindset, because on the weekly, what are you seeing right here? You're seeing a low, you're seeing a high, and then look, you're seeing a break of structure. Now you're like, oh, boom, we're bearish. Let's keep looking for a sell. And look what happened right here. Price came up here, mitigated this inefficiency at an extreme premium zone. Because if you use the Fibonacci from the high to the low, that's extreme premium. We came into the inefficiency at the extreme premium. We displaced, came up, displaced again. We broke structure here, came up, displaced even lower. So you're very confident we should be looking for a sell. In fact, even price coming here, running liquidity, you're looking for a sell, and you're still targeting this inefficiency. You could target that inefficiency for months and still not get there. And the reason is because the 6 months, the 12 months is telling us to look for buys. It's already giving us that signal to look for buys. Look for discount zones. Look for extreme discount zones to buy. Let's not focus on whatever we're seeing down here. Whatever we're seeing on the monthly, that price is showing us we're within this lower high and lower low range. So we should be looking for a sell. Let's not confuse ourselves with that. So understanding this, for starters, is going to be a game changer for any trader at any level. This will help you know why you should be focusing on which direction the market, the 6 months, is already telling us to go to. So the next thing we're going to do now is we're going to scale down into the lower time frames to have a better understanding, key levels that we should be focusing on for trade entries, for buys only. Yes, there's tons of opportunity to sell. Like this was an incredible opportunity to sell. I actually caught this sell. This was another opportunity to sell, another opportunity to sell. But what we will focus on is the opportunities to buy it. Opportunities to buy it again. Now, the next thing we're going to do now is we're going to go to the 3-month time frame. Another 3-month time frame, you can see right here, we have a 3-month inefficiency. One thing I'm going to teach you is, one of the things I'm going to teach you in this video is for you to understand. Now, when we're bullish, if price mitigates a higher time frame point of interest, what can we be targeting? What key level? Now, I'll make this as simple as possible. If we mitigate a 3-month point of interest, in this case, 3-month inefficiency, 3-month fair value gap, I'll be targeting a daily low, daily liquidity. That is the simplest way to explain it. Why a daily low? Why a daily liquidity? Why not weekly? Why not 4-hour? Why not monthly? It's very simple. Just count 3 time frames to the left. 1, 2, 3. This is the easiest way that I'm going to explain this. Don't overcomplicate it. Just count 3 time frames to the left. 1, 2, 3. Right here we mitigated 3 months inefficiency. So what we do, we go and we look for daily liquidity. And where is our daily liquidity? This is daily time frame. This right here is a daily time frame. And what do you see right here? Everything right here is low resistance liquidity. Why is it a low resistance liquidity? I explained this before. The reason is because you can see how price has consistently left external range liquidity. External range liquidity resting all through this zone. Traders keep trailing their stop losses, both retail and institutional traders stop losses being trailed to these lows. That is why this is liquidity inducement, and that is why this is the target. And if price comes to the downside to take this liquidity, it's going to look like what? It's going to look like a break of structure. And then what will traders do? Traders will now start looking for a sell for price to continue lower. Without understanding the reason why we came down there was because we mitigated a 3 months inefficiency, 3 months point of interest, and our target is daily low resistance liquidity. That is what the market was targeting. This is the destination. And the moment price is taking this, anything could reverse the market to run the overall highs. This is the reason why when you take a sell, you take a loss. You take a buy, you take a loss. You take another sell, you take a loss. Another buy, you take a loss. Because the market has confused you. The market has deceived you into thinking this was a break. Don't be surprised. Eventually, we could still take these highs. Why? Because we are bullish on the bigger time frame. Our focus is on looking for opportunity to buy this. Now that being said, as you can see so far, what the market has been doing, how the market came to the downside, took out those liquidities, expanded into this inefficiency, displaced to the downside, Now, if we use that Fibonacci from the high to the low, look what's resting right here. Extreme discount zone. We came into this extreme discount zone. That was an opportunity to buy. We came back down into the extreme discount zone. Another opportunity for buys. This right here has presented you with 2 trades. Look right here. This is a discount. This is pre-equilibrium. Anything below it is discount. And look what happened. We went into premium. After we went into premium, we came back down into a discount. What did we mitigate at discount? We mitigated a weekly inefficiency. We mitigated a weekly inefficiency. And after that mitigation, what happened? Expansion. And what did we go into? Right here. You can see inefficiency. Inefficiency resting right there. That's what price came into. So you can see how you can use the inefficiencies as point of interest. You can use inefficiencies as exits, as targets. You get into a buy from this inefficiency, take profits, another inefficiency. This works both from bigger time frame to smaller time frames. I will show you what I mean. I showed it already. You could have taken a sell from this inefficiency and then a buy from this inefficiency. That sell, you close here, take profits. Another buy from here, right there, you can target another inefficiency right here. You can literally target, you can literally be looking for buys targeting this inefficiency. This is a 6-month inefficiency. So right there, you can literally be looking for buys from here and be targeting price to go here. Look for intraday buys, keep targeting higher. Intraday buys, keep targeting higher. Intraday buys, as the market is gradually going up, you're looking for buys. Down moves, discount buys. Down moves into discount buys, targeting this. I've literally given you a target price where I am personally targeting these prices. I'm targeting price to go to these key levels. The next thing, we start to scale down. I'm going to show you, I promised you in the beginning of this video, I'm going to show you how to get entries. I'm going to show that to you as well. So right here, this key level right here, this key level right here, this is our extreme discount zone. We scale down to daily. We want to see something in there. Something needs to be in there. And what do you see in there? Inefficiency. Again, what makes this inefficiency a significant key level? Because it's resting directly beneath an extreme discount, and we are bullish. So what do we do with this? What we do with this is we want to see price mitigate it, and the moment price mitigates it, we're looking for a 30-minute shift in market structure to the upside. Why 30 minutes? Why not 15 minutes? Why not 10 minutes? Why not 5 minutes? We count 3 time frames to the left. This is a daily point of interest, daily fair value gap, daily inefficiency. We want to see 30 minutes. We just count 3 time frames to the left just to make it as simple as possible. Don't overcomplicate it. I don't want to call it any names, any ambiguous names, or use any ambiguous terms to explain this. Just count 3 time frames to the left. 1, 2, 3. That is the time frame I want to see a break of structure, and then look for a buy. And right here, we'll go to 30 minutes time frame. I'm going to make that inefficiency a different color so it's much easier for us to spot it. So this right here. So we'll go to 30 minutes time frame, and as you can see, this right here, this was the mitigation. After that mitigation, we created a high, created a low, and right here we broke structure. After breaking this structure, what do we look at? We're looking for areas that price could come back for mitigation. And what do you see right here? Inefficiency. Okay, let me teach you something else. How do you use the fair value? How do you use Fibonacci on the smaller time frame for entries? You can draw the Fibonacci from this 30 minutes low to this 30 minutes high. Look what's resting right here. Extreme discounts. You could literally, and look what's resting directly above the extreme discount. Inefficiency. You can literally put an entry here. Stop loss, overall low. I don't use this. I don't recommend using this as stop loss. I know it looks amazing to use it. It will reduce your risk and all, but trust me, I prefer using this. You could literally put your stop loss right here, and price could literally come down to run this, only to reverse and continue higher. And you've taken a loss on a trade that you could have literally just added. This is 12.9 pips, and this right here is 18 pips. So you could literally have added just an extra 6 pips, and that would have saved your trade. But because you didn't want that, you're taking a massive loss. And look right here. That's right there is an entry. Target. Where do you target? Because this is a swing trade, you can target low resistance liquidity highs like this. You can see low resistance liquidity highs like that. You can target those key levels. You can decide this is what I'm targeting, either this or that. And that's literally a 1:20 just on one trade. Now, this kind of trades are not going to present itself every single week. But if you can catch such a trade once or twice a month, you're good. If you're risking 1% on this trade, that's 20%. You're good for the next 3 to 4 months. You are absolutely good. On a $100,000 account, this is a $20,000. A lot of people make $20,000 per year. One trade has given you other people's wages for a whole 365 days. One setup. I'm going to show you re-entries because I promised you in the beginning of this video, I'm going to share with you entries, re-entries using the smaller time frames. I'm going to show that to you as well. So we scale down. Now we've gotten our first entry. We've gotten our first entry position right here. How do we get as a re-entry? This is how we get a re-entry. Now this key level, this is our point of interest. This is the key level where we want to buy from. Why? Because it's resting at our 30 minutes extreme discount, and there's an inefficiency right there. So the moment price mitigates this key level, we want to see a 4 minutes break of structure to the upside. Why 4 minutes? Why not 5 minutes? Why not 15 minutes? Very simple. We count 3 time frames to the left from the 30 minutes time frame that is our point of interest. 1, 2, 3. That is all you need to do, nothing more. 1, 2, 3. The moment price mitigates here, we want to see a 4 minutes break of structure. That is all we want to see. We go to the 4 minutes time frame, and as you may have it, 4 minutes time frame will have a high right here. We'll have a low. This was the last down close candle before expanding to break structure. Personally, I would say use the high as an entry. Yes, this is the best place to put your entry position, but you can see that the difference between this high and this key level, they're not really so much. The difference is not much. It's about 3 pips. So if you use this high here, slippage or spread could make you miss that trade because it's just 3 pips. I don't know what the spread on your broker is. So the best place to place an entry is right here, the high. The moment the high gets broken, use it as an entry, stop loss, this low. You can add 3 pips to it, so it's 19 pips or 2 pips. You can add 3 pips. Take profit, same destination. Same destination, take profit. Now, as you can see how price nicely came down. Took you into that trade. Let's go to 4-hour time frame. 2 trades. 1 is to 10 first entry, 1 is to 18 second entry. Risking 1% per trade. This trade, 1 would deliver 18,000, 1 would deliver 20,000. Do the maths, that's 38,000 on just one setup. And as you can see, price had its ups, downs, and everything. Gave you opportunities you could have used to secure some profits, but eventually what happened? Take profit was smashed. How long did it take? It took from the entry to the day take profit was hit, it took 108 days, which is approximately almost 4 months to deliver $38,000, which is pretty much what someone who's working a good job will earn for 365 days, going to work, coming back, going to work, coming back, and every single day. You made it just sitting on your laptop, pressing a button, allow price to do its thing. I don't care how long it takes, but eventually it delivered an incredible result. This is a concept I teach a lot of people who don't have the time to stare at the chart. All you need is just that one setup, enter the trade, be done with it, allow price to do its thing. Have realistic take profit zones. This key level in the beginning, like I said, this key level would have been a beautiful area to scale out some profit. Every external high is a beautiful area to scale out profit because there's a high chance there'll be a retracement. This is one trade. I'm going to show you another one. And that other one I'm going to show you is from this key level. After price mitigated here, rallied, this right here, this was a high, a low, we broke structure. This now became a new high, a new low. But don't forget that our overall swing high is here. This is our overall swing high, swing low. Within this range, this is our overall high, overall low. So we want to see this high broken significantly, and we want to see price close significantly above it. So right now we haven't seen that yet. Now, after breaking this high right here, after we broke this high right here, what would we expect to see? We expect to see a retracement. To where? where should the retracement get to? How do we know where the retracement should get to? Now, this is our daily range high, daily range low. Now, why is that? We can use the weekly time frame to make it simplified. And as you can see on the weekly time frame already, price is creating lower highs and lower low. You can see that. So that is why here is our range high. This is our range low. That is the range we're working with. Range high, range low. So if we go back to the daily time frame, we are using the range high and the range low. That is where we're drawing our Fibonacci from. So for people who are really confused about how do you draw your Fibonacci, how do you pinpoint the highs and the lows you're using, I've pretty much just explained it right now. We draw it from the high to the low. I'll make this Fibonacci a very different color. And right here, you can see the high, the low, extreme discount. And look what happened. Price came back down into that extreme discount level. Mitigated it right here. After that mitigation, what do we want to see from here? We scale down, we go to 4-hour time frame. We want to see what's resting at the left hand side. And what we have there, we have the major down close candles. These down close candles for expansion. So price coming into this key level, we're looking for a potential 15 minutes break of structure in here. Now, 15 minutes break of structure. We'll go to the 30 minutes time frame to look see what it looks like. And as you can see right here, price actually created a high, created a low, broke structure right here. If you took a buy, you would have eventually taken a loss, or even though it would have given you opportunity to break even because it came back, rallied, came back again, rallied. So you would have used this opportunity if you wanted to buy, throw stop loss to break even. Price eventually reversed, took your stop loss. So even if you didn't break even, you would have taken a loss, which would have still been okay because eventually price created a high here, created a low, broke structure right here. As you can see, this was the high. Now, so you can see after we broke that structure, high, low, break structure. If we go to 15 minutes time frame to see it even much clearer, you can see the high, the low right here. Even though this break of structure right here wasn't really the clearest. So I'll teach you one thing I do. When breaks of structures are not clean, like for example, we wicked the high, came back down, and then we came up. What I'm targeting is to see this high, this wicks here, when there's a candle closure above it. And the only major candle closure I now saw above it was right here, because everything I was seeing was wicks, 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 and then right here, this was the major break above it. So after seeing this major break above it, what I do is I use key levels like this as accumulation zone. This is where I'm anticipating for price to retest. After this is what I'll consider the break. Even though this was a candle closure, but the reason I don't like this is because the candle closure closed beneath this wicks. I want to see the candle closure above the wicks. And right here, this was the only key level, the only area the candles closed above the wicks. So after that, I'm using this because this was the main down move before we now saw this expansion to now break structure. So that is why this area, this entire area, because this right here would have been the main down push before breaking structure. Another thing I do to make it simpler for some people that everything I just said now seems like gibberish. I totally understand. I've been there. What I do to simplify it the most for you, I use the line chart to focus on the bodies of the candle. And if you use the line chart, you can see the line chart is showing you pretty much clearly. This is the high, this is the low. You can see that very clearly. High, low, This was the break of structure. This right here was the last down close candles before breaking structure. That is why this key level is accumulation zone. And the line chart is also showing you, after we mitigated this key level, a high, a low, a break of structure. We're using this high as entry, stop loss here, but I wouldn't place that because this is a line chart. Wicks price could wick these lows. So what I can do in that case is I now go back to this. So if I'm looking for re-entries, this is how I get my re-entries. I can use the high. Then despite the fact that this low would have been the best place to use, this is 11 pips, I can just add like 5 to 8 pips. 11 pips, I'll just use this low here as stop loss, 23 pips. Why? Because I want to give price room to play around. If it wants to play around, come down, mitigate here, come down, mitigate the inefficiency, I don't care. Or come down, even run this low, I don't care. All I'm looking for is opportunity to get into a safer trade that will eventually deliver good results. So this right here would have been my first entry, stop loss here, my second entry, high, low, break of structure. This right here will be my second entry. Where's my take profit position? Still the same target. I'll still be targeting the same area, same low resistance liquidity. We go to the daily time frame, targeting the same key level. First entry 1:12. Second entry 1:12. Both trades 1:24. Risking 1% per trade, they will both deliver 24,000. So as you can see, the first one's delivering 38,000. The second trades that are delivering 24,000. Do the maths, that's literally 60,000. Focusing on one direction. We're not trying to focus on buying and selling it, buying and selling it. We're not trying to sell this. We're only focusing on where is the overall direction going to. That is where we're hunting. The low resistance liquidities. And as you can see, after price came there, go to the 4-hour time frame. After price mitigated that position, the next thing we saw was an expansion. Both trades in massive profit, trailing stop loss to break even, and safe trades. We can decide to even have key levels where we're scaling out some profits, scaling out consistent profits, and as you can have it, take profit smashed. So you can see how you can do this. It's just following one simple strategy. Don't overcomplicate it. Understanding where the bigger time frame is directing us, it's going. Is it going to the upside? Is it going to the downside? The moment we have that understanding, we focus on just one direction. This video right here is game changer for anybody, whether you're beginner trader, intermediate, advanced. Every single thing I've said in this video will help you immensely, from directional bias, how to use the inefficiency, how to use the Fibonacci, how to know your point of interest to use for entries, for trades, exit positions, smaller time frame entries. You may need to watch this video over and over again. If you don't understand it the first time, you can save this video. You can share this video with your friend or your family who you know wants to be a trader, or who you know has been trading, but they are battling with these things. They are battling with consistency. They are battling with understanding whether they are to be a buyer or a seller. If you found this video insightful, feel free to share it with your friends. Don't forget to leave your comments at the comment section. And if you need any kind of support in trading, feel free to reach out to me personally or any one of our team, and we'll be there to help you in your trading journey. I'll see you in the next video.